So can you tell us just what type of policies the State Farm provide, and how they work? I know there's term life insurance, right? Which is something I had. I know one time we talked about some policies that had the potential to pay back. I talked to Joe Taylor. I know he talked about even some annuities in terms of the retirement department. So I know you guys deal with a plethora of things. So can you kind of tell us about some of those things?
Sure. We've got about 95 products that we sell, but for the sake of time and just, the conversation, because this is a great conversation to have, the three main products, excuse me, that we have: term insurance. So I always tell people, term insurance is renting an apartment. When you hear the concept, it doesn't matter what insurance agent tells you, you're renting insurance. So if you hear somebody say, I got a 10-year term, that means for 10 years, your rent's not going to go up, and that's your premium. So you're going to pay the same premium whether you pay monthly or annually. You're going to pay that same premium for a 10-year period. In return, the life insurance company is going to give you a set amount of a death benefit. So it could be $50,000, $100,000, $250,000, et cetera. At the end of that term, that 10-year term, there's three things can happen, just like with renting an apartment. The first thing is the landlord says, hey, you're a good tenant. I'm going to let you renew for 10 more years, and I'm not going to raise your rent. The second thing is the landlord can say, hey, you're a good tenant, but due to the cost of living, you have to raise your rent a little bit. So for another 10-year period, let's say you're paying $20 a month. This 10-year period, you're going to pay $30 a month. Third thing the landlord can say is, you know what? You've been in this apartment too long. It's time for you to go. And that's a term that maybe has an age limit on it. So like I mentioned in the earlier conversation, you could have a term to 70 or term to 75 or term to 80, meaning that once you hit that age, if you're still alive, that policy dissipates. It's no longer available. So that's term insurance. Why is term insurance important? That's the cheapest policy you can buy in terms of the ratio of premium to coverage. So, you can spend $20 a month, if you're young and healthy, and buy a $100,000 term policy or $250,000. I always advise young people who are, let's say you just bought a house and you got to protect that mortgage. I'm going back to this conversation about you don't want your spouse to stress if you pass away. Buy you a 30-year term because you got a 30-year mortgage. You go 30 years, you got your mortgage paid for. That term insurance is still there though. So now you got the best of both worlds. You still got 30 years of $100,000 or $250,000, and you got a paid for house. So now you can take that term, and if you want to keep it as term, just renew it and go another 30 years. The next policy is whole life. Whole life is buying a house, because what whole life is you're buying coverage at a set premium. So when you buy at whatever age you are at that point, that premium will never change, just like your mortgage. And what happens with a house? Over time, you build equity in a house. That's the cash value in a whole life policy. So if you have a whole life policy for 15 years, you look in there and see that cash value, and you say, you know what? I want that money. So what do you do when you have a house? You sell the house to get the equity out of the house. Whole life insurance, you surrender it. You cancel the policy, and they will give you the cash surrender value. That's how you get the money out. But let's go back to the example of the house. Let's say you don't want to sell your house, but you want to get cash out of it. So you go to your lender and you say, I need a home equity loan. I got $100,000 of equity in my house, and I need $50,000 to do a project. So they give you $50,000, and then you just continue to pay that back. You can do the exact same thing with a whole life policy. You can take a loan against the cash value, and then you can pay that back. The great thing about taking a loan on a life policy is what? let's say you got a death benefit of $100,000.
Mm-hmm.
You've had this whole life policy for 30 years. So you got a lot of cash in it.
All right.
You take 20 grand out and you never pay it back and you die. The life insurance company just takes the first 20 off the top of your death benefit, and then they pay your benefactor the rest of the remaining death benefit.
Mm.
The good thing about taking that loan is you didn't have to go to the bank. You didn't have to qualify. You just say, hey, give my money.
All right.
Now, once again, what's the cost? Whole life is about 3 to 4 times higher in premium per month than term insurance. So you're going to pay more at the outset, but the benefits, because you also get dividends in a whole life policy. And all dividends is a return on your premium, because life insurance companies, they don't just take your premium and put it in the bank. They take your premium and invest it. So State Farm, we're a very conservative company, been around for 98 years. So we invest your premium in AAA bonds. So bonds give you a low rate of return, 4 or 5%, but they're guaranteed. And so that money goes back into your policy. So dividends can either accumulate in your policy like cash, or we can set your dividends to buy what are called paid up additions, which is buying additional insurance. So as your policy grows, your death benefit is growing because the dividends are buying the additional insurance, and you don't have to spend additional money out of your pocket to buy that additional insurance. And so there are so many multiple options. The last policy is universal life, which was real popular in the 70s and 80s because of high interest.
Mm-hmm.
The interest rates were super high back then, double digit. Jimmy Carter was in office, inflation was double digit, and then your boy Ronald Reagan came in. I know Jinx, that's his guy, got a poster in his room. But Ronald Reagan came in, and he brought in a guy named Don Regan. Don Regan used to work for Merrill Lynch. And one of the things they wanted to do is get money in circulation, and how our economy is set up now. This is a whole nother show, but their goal was, by slashing interest rates, it forced money out of the banks. So by slashing the interest rates, universal life policies really didn't have the appeal they had, because now you can get a universal life policy and the return is like 3%, which ain't even cost of living right now.
Right.
So I would never advise somebody today to buy a universal life. If you bought one years ago, just keep it and keep funding it. But those are the 3 policies. And then you mentioned earlier about annuities, which are return on investment. And State Farm annuities, going back to what I said earlier, we're very conservative. So your return is very conservative, but it's safe. So, if you don't want to mess around with the stock market and, get you some GameStop and short on stocks and all that other stuff.
Right.
We're like, I got a turtle on my desk. The reason why I got the turtle on my desk is to remind people that, the difference between the hare and the tortoise, slow and steady wins the race.
Right.
And we've been around 98 years, so I think it works.
Wow. Okay.
For somebody that really is trying to, like, is term good enough for me? I mean, I'm probably like 10 into a 30. So, well, as an agent, what would you tell me? And I know,
Excellent question. Here's what I would tell you. You know what the best policy is at the time of your death? The one that's in force. That's it.
Okay.
The one that's in force.
Okay.
Because your benefactor ain't gonna ask me, did you have whole or term? Your benefactor is gonna want to know, did you have life insurance? Let's go back to that love conversation. So, speaking to young barbers, middle-aged barbers, old barbers, what works for you may not work for the next guy. So let's start with a young barber. Young barber that's coming out, he's got no kids, he's an artist, he goes to these hair shows, he's making money hand over fist. I'm gonna talk to him about getting what is called a modified whole life policy. And here's the example. A modified whole life policy, whole life means you pay for the whole life of the policy. So like you take it out when you're 25 and you pay until you 85 and then you pass away. That's what the whole life is. But now we're going to modify it. So I'm going to talk to him about what is called a 10 pay or a 15 pay or a 20 pay. And what does that mean? It means we're taking that time period and we're going to shrink it to 10 years, 15 years, or 20 years. And why are we going to do that? Number one, policy is the cheapest based on your age. So the younger you are, the less premium you're going to pay. So let's say we got a 25-year-old barber in good health, family history is good. I'm going to say, let's get a 10 or 15 pay. It's going to be pretty expensive. And what I mean by that is the monthly premium may be $200-300. But why am I doing that? Because what we're trying to do is accelerate the return of money. If we want a slow pimp, we pay $20. But if we want to get on this fast track, we pay $200. So let's use that concept of $200 for a young person. He opens a passbook savings account at his local bank. And every pay period, every 2 weeks, let's just use that, he drops $200 into the bank. So every month he's got $400. At the end of the year, he's going to have $4,800. And he dies. What does the family get? $4,800.
Yeah.
But if he has a 10 pay life or a 15 pay or 20 pay, so let's say the death benefit on it is $50,000. And he does the same thing with that. And he dies within the first year, they're going to get $50,000. If he goes 10 years, let's use 10 years as the example. And after 10 years, he's still alive. A, he's paid the policy off. He paid the 10-year period. B, the cash value in there may be $30,000, $40,000. C, because it's a whole life policy, it has dividends. So the dividends are going to make that $50,000 death benefit grow. And D, because it's a whole life policy, the cash value, even though after 10 years he's done paying, it's still going to grow. So he could buy a policy at 25 and be done paying at 35. And then at 55 may have $75,000 in a policy that he may only have paid $20,000 for.
Okay.
So that's a young barber, middle-aged barber, or a barber with children. I may say get a term plan. Why? Because now he's got more responsibility and maybe his budget's different. So let's buy 100,000 or $250,000 or $500,000, depending on how much coverage you need, based on whether you bought a house, how old your kids are. Maybe he's focused on protecting his income so they can go to college. Maybe he's not worried about residency. Maybe his girl works or whatever. You know, it really depends on the specific situation. And then an older barber maybe just be looking for some burial coverage. Maybe he's done the proper investment, et cetera, but he wants to make sure that, hey, something happened to me, I just need enough coverage to pay for my services. So I may say, hey, let's get a $10,000 whole life policy or $25,000, something that falls within the range. Because, you know, average cost of a burial is anywhere from $10,000 to $15,000. So let's get you something in there so that something happens, you know, whoever your benefactor is knows that this policy is here. Take this, pay for the funeral, and then everything else he's done with his investments goes to the family.